Interested in real estate? How about wealth? Well, they go hand in hand. And here, you'll learn all about it. Welcome to Be the Bank, a podcast where we discuss and debate the topics centered around real estate investing. Your host, Justin Bogard, shares insights into investing in real estate to create real wealth and passive income for you and your family. He'll share stories of real estate investments done right, walk you through the process of owning a real estate note, and most importantly, educate you so you can be the bank. This is Be the Bank, brought to you by American Note Buyers. Now, here's your host, Justin Bogard.
Hello again, and it is episode number 7 of the Be the Bank podcast, season number 5. I am your host, Justin Bogard, and today I'm going to be talking with Richard Thornton, and we're going to be talking about kind of the banking stuff that's been going around, what we've been hearing on the news and social media, and then also just kind of catch up on how we've been doing. Richard hasn't been on the last podcast, so let's see how he's doing. Stay tuned. Man, that is just a really cool video, isn't that?
I like it. Where did you get those again?
Yeah. So for those of you that are listening on the podcast, we film this via our app called StreamYard, and we post this on our YouTube channel as well. So if you go to the American Note Buyers YouTube channel, you'll see all of our videos of all the podcasts that we do as well. And so, Richard, your question was how do we get that? Well, we basically do a lot of that stuff on Fiverr, as you know. And I just found somebody on Fiverr, and I was thinking about these graphics that we have and how can we make them animated and just make it look kind of fresh and new and cool looking. And sure enough, there's somebody on there that just has templates ready, and they just throw your logo in there, and they can do all sorts of cool animations and stuff.
Well, this one, and actually, you got 3 of them done. They all look especially good. So, congratulations on that. Good work.
There's actually more of them. I did about 8 of them. I hadn't shown you all of them yet. I just showed you the first couple. A lot of them, a couple we won't use, but for those of you that wanted to see that little graphic interchange happen, it's pretty neat. It's like an architect type of theme to it, and it just kind of makes the graphic kind of appear out of nowhere, which is kind of cool. So.
Well, I can just put them on my iPad and watch them before I go to sleep at night.
Exactly. Yeah, they'll be mesmerizing.
What the heck, right?
So you weren't on the last podcast that we recorded. So I had interviewed Marco Barrio. I'm not sure if he caught that episode or not, but it was a pretty good episode. I did have to poke some fun at you because you weren't on the podcast. So I take it, since you hadn't jabbed back at me offline yet, that you hadn't actually listened to it.
True.
So how have you been?
Those of you who don't know, Justin and I have a lot of fun poking fun at each other. So it's all done in good humor and keeps things light. We like it.
Well, today is opening day for baseball. So as we're recording this on March 30th, Thursday, March 30th, which is opening day for baseball, which is a fun day for me because I am a baseball fan. I'm actually wearing my Red Sox t-shirt today because the Red Sox had their opening game today. They lost, however. I wasn't too happy about that. But with the new rule changes that they have going on in baseball, the game was played a little bit differently today. So it was interesting. It's going to take a little bit of time for fans and players to get used to the new rule changes.
So I get where this is going now. Now, having not watched that episode yet, I think you're probably making the reference to the fact that Gita, my significant other, told me I had lost my man card because I didn't know anything about March Madness.
No, I didn't mention that in the podcast.
Oh, there's other reasons. Okay. All right.
No, I didn't. You'll have to play it back and listen to it.
I guess so. I'm going to have to
check out episode number 6, and you'll see a couple of free jabs that I took on Richard because you're
going to have to make me work. Jeez.
Yeah. So that's kind of new with me. So I understand that you just came back from a cabin that you rented out in the mountains for you couldn't do any skiing because you just had knee surgery and stuff, but that's where you guys go to ski.
We do. We actually have a group cabin at South Lake Tahoe. It used to be the old fire lookout for the entire South Lake region, and so it's got a wonderful view. And we like to go up there, especially midweek. We've got to improve the internet a little bit, as you know. That's why I'm sitting here in my office today and not doing it up there, which should be coming soon. But yeah, we had a complete whiteout on Tuesday. We got 3 feet of snow up there, and you literally could not see more than 2 feet in front of your face. And the skiing up there is fantastic right now. So Gita could ski. I couldn't because my knee's not quite recuperated yet. But those of you who want to consider knee surgery, I'm glad I did it, but it's not easy.
There's a few times Richard was a little out of sorts because the medicine he had to take was making him act a little funny.
Yeah, very little funny. Very funny, yes.
Right on. So Richard, you and I haven't talked about this openly on air yet, so I thought this would be a good time to do this. And what I've heard on the news, what I've seen in social media, and I've heard the grumblings from other people was, there is a banking crisis going on right now.
Mhm.
And so I know you had done some research about this, and I kind of wanted you to take us down the path of setting the table here to discuss kind of what information is out there and let us kind of disseminate it.
Okay, yeah. I mean, for all of us who are lay people in the finance world, and I consider that's probably most of us. I mean, I've got a degree in finance, and maybe some of you others do also. But let's face it, we're not in the banking world.
Right.
Out. What we could term this current crisis as is sort of a perfect storm. It's not one big blockbuster event like, say, the last recession was, where we had a whole lot of subprime loans, and that took us down. This is several different factors. One is the banks underestimating the effects of the Fed's interest rate hikes. The other one is the cratering of the cryptocurrency market. Another is the market upset by Russia's war on the Ukraine. And finally, the Credit Suisse and some of the other European banks made overly aggressive investment in hedge funds to try and increase their profitability. And Credit Suisse has been accused by the SEC of allowing money laundering and other nefarious accounts to occur under their noses in their bank. And you combine all that, and that's leading us to where I think we're going. So we can take just a second and sort of go through some of these.
Okay.
You think that a lot of the bankers would know that since in March of 2022, the Fed said, we're going to raise rates. We haven't raised rates for a long time, but we're going to start to do it and do it steadily. You would think that they wouldn't invest in bonds, because Justin, if you invest in a bond at, say, 4% and rates move to 6%, what happens to the value of that bond?
Well, it's lost its value, right?
It's lost value. That's right. So they, at that time, especially Silicon Valley Bank and First Republic, were flush with monies coming out of Silicon Valley and the startups. So they, like supposedly good bankers, took all that money, invested in bonds, which they knew were going to be devalued because the Fed had said, we're raising rates. So one has to wonder why they did that. And that is actually part of investigations that are going on now. But at any rate, they invested that money and got whatever return they thought they were going to get. When the general market got wind of this and they knew that rates were going up, a lot of the groups that had sponsored, a lot of the groups that invested in startups said, you'd better get your money out of Silicon National Bank and these places because they're overextended. This caused a good old-fashioned run on the bank. Well, that meant that Silicon Valley Bank had to now sell their securities at, guess what? A loss. So it meant that they didn't have enough money to cover all of the deposits, and they had to be taken over by the Fed, which in fact made up for all the shortfalls. So that was one big thing. The other thing was the fall of the crypto market. As I think probably most of us know, FTX was one of the biggest players in the crypto market and was taken over, or was actually went under because it was accused of all sorts of nefarious activities, over-investing in some places, actually falsifying reports, et cetera, and that caused the crypto market to crater. Well, Silvergate and Signature Banks were two of the largest banks dealing with the crypto market. They subsequently were in the same boat. Oops, guys, now everybody is, since there's a panic in the market, is trying to cash in on their crypto. They don't have enough money to cover their deposits, so they're in the same boat for a different reason than Silicon National Bank. Third thing is Russia's war on the Ukraine. There's no one factor there, but we all know that gas prices have gone up. Europe was in great turmoil about not having enough natural gas to heat their homes, and all sorts of prices have gone up because of that. So you've got just a whole lot of disruption in the market. This isn't happening all at once, but it's all within a short period of time, and you can see that the markets are kind of getting kind of nervous here. You know, people are going, wait a minute, what's going on? Well, Credit Suisse, in its wise, shall I say, in its infinite wisdom, decided to, in 2021, along with a bunch of other banks, invest in a large family hedge fund called Archegos. Archegos overinvested, couldn't cover its margin calls. The brokerage community got nervous. They started a run on Archegos. Archegos went under. Credit Suisse had a $5.5 billion loss on that, as did several other banks. And you can say, well, what's the big deal about Credit Suisse? Well, the problem is that a whole bunch of other banks had invested in Credit Suisse. And now Credit Suisse was no longer creditworthy. And Credit Suisse is what's called a money center bank, which means that they're one of 30 banks around the world that make the money work. When we send Fed wires, when we do all these things, they're the backbone of that system. And all of a sudden, if your backbone is getting pulled out, guess what? You've got problems. And the last little thing that I'll mention, so I won't bore you anymore, is the fact that the SEC started to look at Credit Suisse's bank accounts and said, you know what, guys? We think you're allowing money laundering, and you're allowing a lot of guys from Colombia and other governments to launder money through your bank. And lo and behold, they were caught, and in fact, they are being prosecuted thus. So all those things combined are sort of a perfect storm that's leading to the bank crisis that we are in, and I think is only going to get worse.
Okay, that's a lot.
That's a lot.
So I'm glad that you had mentioned several of those things that I hadn't heard of before. I haven't really dug into the Swiss bank information that you had. I had just read more or less the stuff about SVB, Silicon Valley Bank, and how they're buying treasury notes at 1% and trying to cash out of those said notes, and they can't get enough money out of what they invested in to be able to pay their depositors back.
Right. I mean, Silicon Valley Bank would have been best off just to do nothing. If they had just kept the money in their coffers, dollar for dollar, if you put in $10 and you ask for $10 back out, you're good.
Yeah.
But they invested it and invested 10 and got back 8. Oops.
So guess who bails them out?
Yes. It's your tax dollars at work.
Several banks bailed them out.
Right, but the Fed guaranteed all of the
the uninsured ones too.
Yeah, something I didn't know. So I bank at First Republic, and I was talking to my rep there, and she was saying, "Oh yeah," she said, "you'd be amazed. All these people that have $10-20 million in the bank, they're all splitting them into all sorts of different names that they have control of, their kids and everything like that, all under $250,000. So they're all guaranteed by the FDIC. And I thought, holy smokes, I had no idea.
Yeah, I think what the government's going to learn from this is that, number one, the Fed's probably going to raise their insured accounts probably to a much higher amount than 250. But yeah, I can see a lot of wealthy people doing that, splitting their money into multiple accounts so that they're federally insured for that 250. But I did hear that the Fed, when I read this morning some stuff, that the Fed was from SVB, they're insuring everything. They're insuring the uninsured amount.
Yeah, they want to keep the system. The decision they've made is it's less painful for us to just basically absorb all the loss than it would be if we let everybody go down. And that's a rational decision. I don't blame them one way or another for that. They're smarter about that than I am.
Well, yeah, it seems like no matter what, our safety net is always the government just printing more money.
Yeah.
Somebody else bailing it out. But the other banks are, they're making an investment. It's not like they're just giving them money. They're making an investment in those banks and just, propping them up so that they don't collapse, because the consumer loses in the end, right? Not the bank.
Yeah, exactly.
The consumer loses.
One way or another, the consumer loses because we've got higher rates somehow, or we're having to pay more taxes to make up, or, we don't have enough money for this, that, or the other, whatever it is.
So how do you see this getting worse than it is right now with the gloom and doom news that you just told me?
Well, unfortunately, one thing I find interesting is that as I read through a lot of this stuff, there were people that foresaw this. There were people who early on said, "Hey guys, Silicon Valley Bank is making investments that are going to be underwater, and Credit Suisse is doing this and that." So, as with the previous recession, there's a lot of people who are just being ignored that should be paid attention to, and I don't quite know why that happens. But what most of the pundits seem to be saying is that we're in a crisis. It's probably only going to get worse, and it's probably going to end up in a recession sometime soon. That's the gist of it.
So what does Richard think?
I think I'd have to agree with that, because the evidence is just so overwhelming. The system can only take so much, and this is what I call sort of the nick effect. You can die by 1,000 nicks. No one big cut is worse enough or bad enough to kill you, but you get 1,000 of them, and all of a sudden you don't have any blood pressure.
Yeah.
So I think the Fed can only do so much on the American side. My understanding is that the gas crisis, natural gas crisis in Europe, was actually resolved by the fact that the U.S. and other countries shipped boatloads and boatloads of gas there, natural gas there, and basically made up for the shortfall, which is amazing to me. But still, you got so much going on, that negativity in the markets. I just don't see how it. Maybe it's not recession. Maybe it's just a total tightening. Okay. One of the big things that's going to happen is that rates are going to stay up, and tightening is going to occur. And so it's going to make it better for private mortgages. I don't know about you and your portfolio, but I've actually been dismayed because equity's been up, values have been up, and I've probably had now 5 different refis on my mortgages that I never thought would be refi, that were nice, easy peasy loans. Well, they were all at 9%. These people are refining at 3%, and I'm SOL. That activity is going to stop.
Yeah, I don't see the rates moving at all as far as interest rates for the consumer. I think they're already set where they should have been anyways for a while. But I agree that the lending is going to get really tight again, because the banks are going to be extremely conservative about how they lend money and who is going to be a worthy borrower. And so that's, like you said, it's only going to make our private mortgage, seller financing, owner financing business even more popular for real estate people to do, because people are still going to need money to buy houses. The interest rates are not going to go down. They're not going to be able to afford as much of a house as they want because of where the rates are at and what their money can't afford. So the the homes that are 150K and under, that's really going to be the super sweet spot for these private mortgages, and that's really where we want to land.
Yeah, I think it actually is going to start to. We're starting to see more what I'll call smaller commercial, anywhere from the $1 million to $5 million category. Commercial mortgage needs also, and they'll probably be 5-year loans. You and I haven't talked about this,
Yeah.
but I've actually gotten 3 or 4 inquiries lately about would we, in fact, either make and or buy commercial loans like that.
So this banking stuff, it extends more than just the consumer. This is going to the Senate and the House. Like, they have to make decisions on if they're going to raise that debt ceiling or not, because they have to print more money, or the Fed can't bail out anymore, right? They can only bail out so much, and these other large banks, CP Morgan, Goldman Sachs, or whoever the big ones are, Bank of America, they can help the situation as well, which they have been feeding money into some of these banks and stuff to help stand them up. But what I'm getting at, Richard, is that I can see this being stress to the economy, and I can definitely agree that the economy will be the stock market will be even more volatile than it is right now. And so what that does is for people that are consumers that are wanting to invest their money, number one, our title of our podcast is Be the Bank, right? So we're
Right.
saying all these negative things that are happening with the banking industry, but that's not really what we're doing. We're trying to be like a bank as a metaphor, not actually be a bank. What we're saying is you want to be a lender. You don't want to keep all your money in that bank. You want to put it out there in an asset, a hard asset like real estate, to where you're getting income from that real estate. And that real estate is strong right now. It's only getting stronger because we're going back to more of a seller's market again right now in the industry as it stands. So it's even more obvious to me that people should really be hyper focused on real estate as an investing tool with their retirement if they haven't thought about it already. With all this stuff going on, so I think you're right, Richard. I think we will dip into a recession. I don't think it's going to be catastrophic at all, and I'm not going to sit there and
No,
say
I'm
that
not.
it is.
No, it's more of a dip.
Yeah, it's just going to take a step back, and I think 2023 is just going to be a year where things are just going to kind of slide down a little bit. It will get back on its feet because the government always has a way, always has a safety net, right? That they can
Right.
go in there and stimulate the economy, and they can do other things. But even some of the bigger CEOs, like the Elon Musks and the other big time CEOs, are all saying, like, right now, in their work, because they're heavily in the market and stuff, they're saying they're holding their cash. They're waiting for that right time. They understand that by maybe quarter 1, quarter 2 of 24, that's really where they're going to start getting in there and start buying things so that they can start elevating the economy, because I think that's going to be a low point for a lot of the stuff in the market. So that's kind of what they've said that they're doing. And I've only heard this like the last couple of days, just, off of maybe not a reliable source. It's just off of some interviews that I've heard off of feeds on social media and stuff. But that kind of makes sense because they're kind of seeing the light. They understand that we're going through just a weird time right now. And everything is cyclical that we do, right? Real estate and the economy and the stock market. And so this is just the time to where things are just going to dip a little bit. And then it's probably going to take off pretty well in 24 and 25 to be, start trending in we call it a bull market, where it's trending
Right.
in the right direction. And we're just dipping into a bear market right now.
Yeah, I agree with that. And also, we haven't really talked about this on our own separate portfolios, but I think you've heard me mention a couple of times. Out of all the notes that I've purchased, I've only had 3 defaults.
Yeah.
And knock on wood, I haven't lost money on any of them. I think I may have one that I'm going to lose a couple $1,000s here next year, but there's a lot of security in that. I mean, we're so below market in terms of our loan to values and everything like that. I've got one right now going on in Illinois that very sadly the woman was disabled. She ran into some financial problems, and she's signing the house over to me. But I'm not going to lose any money, and I'm probably going to make $1,000. But not that that's the point is I'm not losing anything, and nor will my investors.
You had a safety net, and it wasn't the government.
Yeah, exactly.
Your safety net was that real estate, and that's what's beautiful about what we do. So
right.
it's an even better time to be managing a fund like we're managing. It's even a better time to be in real estate. If you don't want to be the fix and flipper or the wholesaler, I completely understand, or even a landlord. But making passive investments and having everything secured and backed by real estate, this is really a great time to be in it. Real estate is just always going to appreciate. We did have a anomaly, 13 years ago when we had that financial crisis. But you did a great job of explaining that in the beginning of when you went into your research a few minutes back, about saying that was a different type of problem. That wasn't any doing of what's going on right now with people, money laundering. That had a lot to do with, lending being too loose and rates just going in the wrong direction. And then, it was a snowball effect. And then before we knew it, we had way too many defaults, and then everything just kind of.
Right. I mean, the only similarities really were that there were some people out there who were saying, we have a problem early, and people weren't listening. And so I always find that curious as to when people are making a lot of money, they tend to not listen to somebody saying, there's a problem here.
Yep, you're exactly right.
I don't know if it's just straight greed or what it is, but
they have blinders on, right? It's a tractor beam. They're in a tunnel that says, "Oh, this is a super speed highway. I don't have to slow down at all because I don't have to get off my exit for another 100 miles." Right? They don't see all the noise, the blur that's going beside them, and so that's you're exactly right. That's what happens. But we all do it. We all miss the boat. On the opportunities to buy crypto when we could have bought it. Not that I was going to, but that was an opportunity to buy it because you knew that it was going to go up, and you also knew it was going to crash as well. So I feel sorry for the people that did invest in that, and hopefully they can recover from that with something different. But yeah, it's just an interesting time that we're in.
Yeah. So the ultimate investment, though, that I've researched, this comes under the category of I wish I had.
Yeah.
Yeah. So I was very well employed and making a decent amount of money. Not that I'm not now, but in 1985, I figured out that if I had just bought Apple stock in 1985, which was selling for about 11 cents a share because Steve Jobs was just getting kicked out and blah, blah, blah. So I would have had to have been a contra-cyclical investor. That with the stock splits and everything else, that today that investment would be worth almost $120 million.
Wow. That'll frustrate you.
Yeah. No, you can't, shoulda, woulda, coulda, but it was an interesting piece of little research I did.
Yeah. That's the funny thing about being in the stock market. You can be extremely wealthy all of a sudden, or you can lose it all.
Yeah. I mean, this case, you had to really believe in Apple. Yeah. And they had a 2-for-1 stock split. And then several years later, they had a 7-for-1 stock split. And I don't know if you've ever been through any stock splits. I have, but wow, that can increase your value, in 2 or 3 years, a whole lot. But they don't happen very often. And it's like rolling dice. It's not like what we're doing, where you've got a lot more steady Eddie and there's a lot to be said for.
What we're doing is predictable, and it's really secure.
Yeah, there's a tortoise in the hare, and get the one.
Right, tortoise in the hare. Awesome, Richard. Well, this was a good conversation today. Thanks for doing all that research and bringing light to what's going on with the banking crisis and what could happen and what kind of maybe we both project in the future. So this is episode number 7 of the Be the Bank podcast, sponsored by American Note Buyers, and we will catch you on the next episode. See you.
All right. See you later. Bye-bye.
Thanks for listening to Be the Bank. We hope you learned something from today's show. If you enjoyed this episode, please rate and review us. Plus, check out our channel on YouTube and follow us on Facebook and Twitter at Be the Bank and on Instagram at Be the Bank Podcast. Be the Bank is sponsored by American Note Buyers. Thanks again for listening.